Hello, and welcome to our RKL webinar series, Coronavirus and its Impact on People, Process, and Profits. Before we start today's call, we would like to share a couple housekeeping items. This webinar is being recorded. We will provide you with a link to the recording when it's available via email. All materials were emailed to registrants around 10:15 this morning. You can also find materials on our Coronavirus Resource Center at rklcpa.com. All lines are muted and will remain muted during the webinar. Questions can be submitted using the Q&A button at the bottom of your screen. However, due to the size of the group today with more than 900 registrants, we will only have time to address a few questions throughout the webinar. RKL clients who have questions specific to their organization should reach out directly to your RKL advisor. 1 hour of CPE in the field of business law will be issued to participants on this call. To be eligible for CPE, participants must be connected to the session, both audio and presentation, for its entirety. Additionally, participants must answer 3 polling questions as elements of engagement. If you're viewing through a web browser, ensure you have pop-ups enabled. Please make sure Zoom is your primary window in focus. If the question does not show, just click the presentation screen and the question should display. If you're using multiple monitors, the poll may appear on your second screen. At this time, I would like to turn the presentation over to Ryan Hurst, who will introduce our team for today's webinar. Ryan, the floor is yours.
Thank you, Steph, and good morning, everyone. The first thing I'd like to start with is recognizing our team on the call today, and also a huge thank you to someone that you can see is not part of our team for today. That is our Ironman webinar presenter, Eric Wenger. After 5 sessions, this is session number 6. After the first 5 sessions, Eric is finally getting a much-earned break. Also like to introduce a new face to the webinar series today, Bethany Novis. Bethany is a partner in our business consulting services group. She's going to be speaking with you today about loan forgiveness and cash flow forecasting. And then also a welcome back to Stephane Smith, who is a consultant in our human capital management group. Stephanie is going to be presenting on frequently asked questions, workforce retention, and reinstatement. And I am Ryan Hurst. It's good to be back. I will be presenting on an overall kind of update on the coronavirus, as well as an update on the PPP loan program in a moment. First, though, I'd like to bring up our first polling question of the day. We will be bringing that up in a second. As a reminder, all participants must answer 3 of the polling questions, which will be held throughout the presentation. They must answer 3 polling questions to get continuing education credit. Your answer doesn't really matter to the question. It's helpful for us to know, but it's more a matter of whether you actually answered or not as to whether you receive credit. There are no wrong answers. Our first question you should be able to see on your screen: has your company received your PPP loan? Yes, no, or we didn't apply. We will leave that up for a few minutes. Just as a reminder, make sure you answer this question if you are looking for continuing education credit. But with that in mind, I'm going to get us started because we have a pretty busy agenda today and want to make sure that we stay on time. So I'd like to begin by sharing a note from one of our clients who reached out to us last night. It said, in part, "I am reminded of Sir Winston Churchill's 1942 speech after the British outfought Rommel at Alamein, clearing the Germans out of Egypt. That was a turning point in World War II. Churchill's driving point was, now this is not the end, it is not even the beginning of the end, but it is perhaps the end of the beginning." Our niece and her husband are medical doctors working at Columbia University Hospital in Manhattan. Many of their co-residents have been infected and after recuperating are working to help patients and within their research are hoping to provide positive results for all. Their clear prediction for us states, this virus will be with us for a long time and we need to continue following prescribed guidelines. This is only the beginning of the pandemic. I was touched by these words, and I think it's really critically important for all of us to understand where we are at in this pandemic. So we as business owners and executives, we can all make informed decisions and be prepared not just for the next 8 weeks, but the next 8 months or probably longer. So with that in mind, the truth is we have many open questions as a society on the science behind this virus. There's a lot of speculation on this, but you can see how that speculation has played out thus far. For example, we were told that masks weren't necessary to conserve them for hospital workers, yet yesterday afternoon we saw the House of Representatives meet in person to discuss stimulus phase 3.5 while wearing masks. Now, I say this with no political bias or condemnation, but simply as a word of caution, so that you, as business owners and executives, can make decisions that impact your employees, customers, and stakeholders, and yourselves based on solid, or at least not unconfirmed, information. Now, I certainly don't intend to cover all the details on this slide. For our purposes, it's meant more for examples than to dive into the detailed scientific discussion. The key takeaways here are we don't know whether warm weather will have any impact on the coronavirus, particularly the significant let up that many of us are hoping for. And if it does let up, will there be a second wave in the fall or winter? What is our current level of infection? Does immunity exist for those who have been infected, and how long will that immunity last? Do and will we have the testing capacity with a high degree of accuracy to answer some of these questions? When will a vaccine be made available, and what will its efficacy be? What long-term mental and physical health and behavioral effects will this have? Without knowing the answers to these questions, what are some of the things that we can expect in the interim? Possibly waves of infections, rolling closures, intermittent lockdowns, bans on large gatherings, limitations on businesses and operating conditions, travel restrictions, constraints on essential supplies, strain on the healthcare system that includes people, equipment, supplies, and even the potential for immunity passports, where you essentially get some sort of a card or some sort of notification that you've been cleared of the virus, you've had a positive test and have recovered from it, you essentially have immunity. So with that in mind, it's important for all of us to consider how each of these types of factors may impact our businesses. Now, our goal each week is to provide you with the best information available in a time when it's lacking, in part due to bad information and much more so due to a lack of information. Now, I want you to know that we stand behind those that are working diligently to rectify the latter, and we continue to do our part as your advisor to provide you with the information that you can trust. Now I'll switch gears and spend a few moments on the PPP program, covering some updates on that program before turning things over to Bethany. First off, just as far as the current state, the PPP program, as I'm sure you heard, ran out of its $350 billion of funds in 13 days, or last week on April 16th, 8 days ago. At that time, more than 1.6 million loans were made across more than 4,600 lenders nationally, with an average loan size of more than $200,000. Unfortunately, independent contractors and self-employed individuals were at a disadvantage, and they couldn't apply until April 10th, with guidance on them only being issued on April 14th. So where did the first round of PPP go? Well, not surprisingly, construction companies received $34 billion, or 14% of the funds, followed by professional services companies with $30.3 billion, or about 12% of the funds. The largest proportion of loans were between $350,000 and $1 million. So while there's been a lot of notoriety or a lot of press lately on some of these very large loans that were funded, these loans generally were funded at a less than $1 million level. And finally, for many of us who are in Pennsylvania, Pennsylvania received $16.7 billion of the loan proceeds. For those of you who did receive funds, with the 8-week forgiveness clock starting immediately upon the receipt of the funds, it's critical to have a framework in place to maximize your potential forgiveness. A few of our recommendations are to consider opening a separate bank account to hold these funds. I know many of our clients and folks that we have talked to have even tried to go as far as to use this account and really link it up directly with their payroll providers, but have seen a lot of obstacles on that. It's a big challenge. So probably the more practical best practice is to utilize that bank to kind of payroll account in the exact dollar amount that you expect to go out the door in payroll. So you can create a nice paper trail there and is easily documented, because documentation is going to be a large part of this process. It's also critical, and I would think this would go without saying, but it's critical to make sure that you use the funds for payroll and other approved purposes, to think carefully before conducting any layoffs. As Bethany will share with you in a little bit, any such layoffs can have an impact on the potential forgiveness of the loan. And lastly, certainly don't assume that the loan is just going to automatically be forgiven. Make sure you follow and understand the guidance, ask for help, and stay tuned as more guidance is expected to be forthcoming, because we're not in a state of perfect information at this point. Now I'd like to talk to you a little bit more about the stimulus phase 3.5 and the PPP refill. As many of you are probably aware, the government is in the process of refilling the PPP as part of stimulus phase 3.5. On Tuesday, the Senate passed a bill and the House passed this bill yesterday afternoon. The president is expected to sign it at noon today. This bill, among other things, will add $320 billion of additional funds to the PPP. A portion of these funds are earmarked for smaller financial institutions, with the thought that these institutions will provide a better conduit to the small business community and some disadvantaged businesses. Phase 3.5 also includes additional funds to refill the EIDL, funds for hospitals and other healthcare providers, and for coronavirus testing. As an update on timing, Marco Rubio, Senator from Florida, this morning indicated that this is expected to launch Monday morning. So you should definitely be prepared for that relaunch if you have not already applied and received one of these PPP loans but remain interested. And finally, check with your lender if you did already apply but were not approved to determine whether you need to submit a new application or whether that existing application is already in the system and it still stands. Finally, I want to call your attention to some of the negative press and the public and political scrutiny the program has received over the last few days. About 90 large publicly traded companies received funding under the PPP, presumably by following the rules, but taking advantage of a widely known loophole that was put into place at the onset, specifically for food service and accommodation companies, as well as franchises. While some of these companies have opted to give the funds back, this has led to a black eye on the program and a lot of grandstanding in Congress over the last few days. This has also led to a new FAQ that was issued yesterday morning, and a copy of that FAQ is on the right side of this slide, and it's referred to as FAQ 31. FAQ 31 specifically calls out public companies. Now, I'd like to bring your attention to some other language and a perceived shift in the rules, depending how far they go with this FAQ that was issued. When applicants signed up, they certified that current economic uncertainty made the loan request necessary to support ongoing operations of the applicant. This is a pretty ambiguous statement, but it is one that is now being at best clarified to consider other sources of liquidity. This has effectively led to a requirement for the public companies to return the proceeds, potentially adding hundreds of millions of dollars back into the PPP system. That much is known. The big unknown is how much further this will go. And what about lines of credit or an owner's personal wealth? An unlevered balance sheet or excess cash in the balance sheet mean, these could be deemed as other forms of liquidity. Is the government suddenly going to call into question whether if you have access to funds under a line of credit, that is going to be considered access to liquidity? We don't know the answer to that, and that's something that we're looking to find out hopefully in the coming days. But it's very important for us all to be aware of that right now. I don't want to create any panic, but it's better to have that as a known and have to potentially address that as part of this process rather than get caught with it at a later date. So our recommendation, while this is certainly one of those areas that we don't have all the answers or hardly any answers, it is important though to proceed with caution, stay within the intent and the spirit of the act, use the funds appropriately, particularly to keep workers on payroll. That's the primary intention of this act. It's the Payroll Protection Act. It's not the Overhead Protection Act or anything like that. You know, it's the gateway into getting rent, utilities, mortgage interest forgiven is going to be through payroll. It's not going to be the other way around. That's been made abundantly clear. And finally, if ultimately you've had a change of heart, it's recommended, and there is a deadline to return the proceeds by May 7th to avoid any repercussions. That's all I have for you for today on the PPP. Bethany is going to be getting into a little bit more detail on that in a moment. And first, I'll turn it over to her for another polling question.
Thank you, Ryan. We're going to bring up a polling question. Let me just get you out. There we go. So a reminder again, you must answer all 3 polling questions. The first is on your screen here. What aspect of loan forgiveness concerns you the most? The definition of qualified expenses, calculation of FTEs, documenting my economic need, or the overall ambiguity Friday here. So if you could answer that, we are going to continue on here, again, in the interest of time, with a lot to cover as you answer that question. So today we're going to cover the loan forgiveness, PPP basics, and cash flow forecast as it relates to loan forgiveness. I thought I'd start and pick up where Ryan left off, just on the intent of the loan, because that's really going to be our guiding light as we navigate the gray areas. So the PPP is really designed to help all of us in our businesses to provide cash so we can keep paying our employees and cover qualified expenses. This financial relief is intended to help the small businesses quickly return to being fully operational once conditions improve. Easy definition, but as Ryan said, there's a lot of moving parts and fluidity, and we really don't have an understanding now even how the virus is going to fully affect our business and our personal lives and our employees. So let's spend some time navigating the uncertainty of the PPP forgiveness, and we'll share with you what we know and what we don't know. First off, it's important to understand the covered costs. So as Ryan said, you have a covered period, which is 8 weeks from the time you receive the loan. So for everybody out there, your covered period is custom to you the day your loan is funded for 8 weeks. There are 4 buckets. You see them on the screen, most notably payroll cost, paid and incurred, then mortgage interest, rent, and utilities. Together, these 4 buckets can make up your maximum eligible forgiveness. The first hurdle you must get over is that your payroll costs need to be your most significant covered cost. Again, going back to the intent of the PPP loan program. Stated another way, the mortgage interest, rent, and utilities cannot be more than 25% of your total forgiveness. Now, we have had questions, is it pass or fail? It is not pass and fail as we understand it at this point, but it will reduce your eligible forgiveness. If you don't have the 75%, that will reduce the amount that is eligible for forgiveness. Then the maximum eligible forgiveness can be reduced by 2 haircuts that we're going to cover today. They're related to your FTE headcount and salary reductions for employees making less than $100,000 a year. I'm not going to spend a lot of time on the qualified payroll costs because there's a lot you can read about this, but I did want to emphasize again, These may have to make up 75% of your forgiven money. In addition to the gross pay items such as salary, tips, leave, and severance pay, there are 3 items that are employer expenses: the health insurance premiums, employer match on 401k, and employer portion of unemployment taxes. One note here, the compensation is limited to $100,000 annualized, which is the magic number of $15,385 for the 8-week covered period. However, you do not need to limit the other items for the individuals making over $100,000. You can take them dollar per dollar. You don't need to prorate them or perform any other mathematical calculation. Note that the covered benefits are for employees only, not owners. Oops. One question here we thought we'd start with. We're getting a lot of this week. So I'm self-employed. How do I calculate my payroll costs? If you are self-employed and don't have a traditional payroll check, the owner compensation will still be limited to 8-week covered period, 8 out of 52 weeks, proration of your 2019 net profit per individual owner. Again, this is the $15,385 limitation. You must exclude qualified sick or family leave where your credit is being claimed under the Families First Corona Response Act. So in that case, I would go back to last year's tax return, and that would be your starting point. Note that I would suggest you check with your lender, and I'm going to say that several times through this presentation, because the lender is going to be the one that you're going to file for forgiveness with, and see how they may treat non-cash items such as depreciation. Now a note on the non-payroll related eligible expenses, which you see on your screen. There are 3 here: the mortgage interest, the rent, and utilities. I'm just going to highlight some of the questions we've had. A lot of them revolve around related parties. As we understand it now, interest and rent payable to related parties are allowable as long as your agreement is in effect prior to February 15th. So please make sure you have your lease agreements, they are in effect, and that you have them handy. And please make sure that it's a business purpose and it's consistent with prior years. If not, and you have any questions, I would say contact again your banker or your business advisor for different questions that may be custom to you. So what does cost incurred and payments made mean? Well, at this point, we're interpreting this to mean that these expenses must be related to a date that falls within your covered period, for instance, a service date for utilities. And we're using the accounting definition that they must both be related to this, and also the disbursements or payment must be made before the last date of the covered period. I'm sure we'll be getting guidance, or maybe I hope we'll be getting guidance on this, and we will keep you updated. But at this point, we just want that on your radar, and Stephanie's going to talk a little bit more about that in the next section on how that relates specifically to payroll. So let's go through a simple calculation just to get you in the know here. We have XYZ company with $1.2 million of total payroll cost. That's $100,000 a month in 2019. So that resulted in a maximum loan for them of $250,000, which they were awarded. During this 8-week covered period, they receive the loan and incur payroll costs of $200,000 and then rent and utilities of $30,000. Under this calculation, XYZ would be eligible for forgiveness, maximum eligibility of $230,000 of their loan total of $250,000. This is before any haircuts. The lower numbers because they only incurred the cost of $230,000. Here's a nice visual because that's kind of how I learn. It's very simple to look at, but you can see the total loan of $250,000. Now they go down to an eligible amount of $230,000, and then they have $20,000 left that would presumably convert to a loan payable. We'll talk a little bit more about that. So this is their starting point. They have a 92% loan forgiveness. Not bad, right? My sophomore in high school reminds me that a 92% is a pretty good grade. So not 100% though. I know we want 100% here. So we look at the first test. They are above 75% on payroll. And in fact, when their loan forgiveness comes in at $230,000, 87% is being spent on payroll. So that's where we're going to start. However, it's not that easy. Now you take your maximum forgiveness, and they can be reduced further by 2 potential haircuts. And this goes to, again, the intent of the program. So the PPP loan forgiveness depends heavily on your ability to restore your FTEs, your full-time equivalent employees. There's going to be several measurement periods that will be important to you. This is the prior year, January and February of this year, April 26th, which is coming up here, the end of your particular covered period, and then June 30th of this year. The goal here is to restore your FTE headcount and also keep certain pay levels to get full forgiveness. So let's go through that in detail. So there's some haircuts, and I don't know about you, but I could use a good haircut right about now. But there's nothing worse than a bad haircut, right? Everybody's had a bad haircut, and these are bad. These are very punitive, and these should be on your radar. Haircut number 1 is a headcount reduction, where there is a percentage reduction in your forgiveness proportionate to your reduction in FTEs. And we were going to spend some time on how that's calculated, but especially if you have a small workforce, it becomes very punitive very quick. Haircut 2 is a salary reduction. There's some gray around this calculation that we'll cover, but the spirit of it is a dollar per dollar reduction in your forgiveness based on amounts that you lower your salaries for the employees making under $100,000 per year. Basically, they're allowing a 25% reduction in these salaries for the under $100,000 a year, but anything in excess of that hits your forgiveness dollar per dollar. And I'm going to cover some of the gray areas on this too. Let's walk through the headcount reduction. You should be able to calculate your average FTEs during your 8-week covered period. Then what you're going to do is compare those FTE counts per month to either the February 15th to June 30th last year period or January, February this year. I will note that if you're seasonal, you must use the February through June period. Other types of employers can select which period to use, and it's advisable that you use the periods with less FTEs to avoid an unusually large penalty. Let's take our XYZ company and assume that they had 24 FTEs last year, this year, January and February, and 20 FTEs last year, February 15th through June. What you would do at this point is look at how many FTEs they have during the covered period. If they have 18, you would compare that to the lower number of 20. That's a 2% reduction or 10%. In our example, your 230 maximum allowable forgiveness is then reduced by 23,000 or 10%. Now, a spoiler alert here, there is an ending to this story that has a twist. Stay tuned. Let's talk about FTEs. We're getting a lot of questions on these. Here's a calculation of FTEs taken from the SBA. There's a lot of different ways to calculate FTEs. At this point, we're using the SBA definition, but please, again, talk to your banker or watch and we'll bring you more guidance as this unfolds. The SBA FTE definition is any employee working over 30 hours a week is an FTE. So you measure it actually on a month, and we have 3 FTEs in this scenario, Jim, Gail, and Mike. The other employees, other 5, are part-time. You take their aggregate hours per month, divide by 120, and that comes up with FTEs. So you can see, in this case, they had a headcount of 8, but FTEs of 5.4. I'm going to quickly show you the incorrect computation, which would be adding everyone's hours and divide by 120. That results in an unusually high amount of FTEs because you're counting your full-time employees as over 1 FTE because they work in excess of 30 hours. So again, incorrect. Let's not do it that way. Now, let's assume that you let go 1 FTE, Mike, and then 2 of your part-timers. You actually have 3 employees you either furloughed or laid off. They worked a total of 278 hours a month. Mike counts as 1, and we would add Danny and Kim together for 88 hours, divide by 120, and you get 0.7. So your total FTEs in this scenario is 1.7. I bring this up because, again, you must do apples to apples in how you calculate it, or you can end up with some very harsh penalties on your calculations that don't make sense. And this also can help you with your strategy as you try to bring employees back and are looking at the mix of employees, or maybe their tasks have changed. Restoration of forgiveness. Here's our spoiler alert. So you ask me, what happens if I don't restore my headcount by the end of the covered period? Am I out of luck? Is there any way to restore your FTE headcount haircut? Well, yes, there is. Even if your FTE headcount is down at the end of the covered period, you have one last shot, and it's called the restoration of forgiveness. If you restore your FTEs by June 30th, any haircut for FTE restoration will be forgiven. Now, I've been running through this presentation late last night. The guys in my life, which is my husband and my son, have been listening. My husband told me restoration of forgiveness. He thought, I asked him what they meant. They thought I meant by this because their ears perked up. My husband thought it involved flowers, a nice dinner, and maybe some jewelry, depending how much forgiveness you need. My son, who's a sophomore in Catholic school, was pretty sure it was something that could only be granted by the Pope, and he probably learned about it in theology class, but wasn't quite sure. All good tries, guys, but I like this one better. Restoration of forgiveness, yes, please. The moral of that story is, if you don't think you can restore them by the covered period, keep that June 30th date in line, although realize you also need a certain level of payroll, so if you wait to bring employees back, you might be down on payroll costs. One mention of haircut too. This has to do with reduction in wages for any employee making under $100,000 annually per year. The spirit of this is that they don't want you reducing their pay over 25%. However, the calculation now is written comparing the covered period of 8 weeks to the last full quarter of 13 weeks. As you could see, that would already reduce pay by down to 67%, I believe. So I expect more clarity in this area. But for discussion purposes, I wanted you to see how it plays out. I think they will equalize it. But just look at your employees. If you reduced anyone over 25%, I would strongly consider you restoring them back as much as you can with your PPP funds early in the process. For this calculation, we're going to assume that the hit, dollar per dollar hit, is $10,000. And this is a person to person, so you must consider each person as an individual and not an aggregate reduction. Let's see how it all adds up for our XYZ company. They got $250,000, but now they're only getting $197,000 forgiven, which is 79%, which I remind my son is actually a C. That is not a passing grade. Well, it's a passing grade, but it's not as good as the 90-something% we looked at earlier. There's $53,000 there that you're not able to forgive. $20,000 because you did not spend the proceeds, you only spent $230,000. And then you're getting hit with a 10% FTE headcount reduction and a $10,000 salary reduction. Looking at this quickly, if you added back your headcount, you could get rid of the $23,000, 10% haircut, and you would probably get rid of the $20,000 unspent loan proceeds. That would be $43,000. You may have some money over to do salary restoration, or if that's one person, maybe you could bring their salary up and spread out the pay cut over other employees or recalibrate your workforce that way. But this gives you a good idea of some strategies of where you would go next. So what happens with that $53,000? What if your loan is not forgiven? Well, you should have signed a loan document, or you will if you receive the PPP loan funds, which has a 2-year repayment term and a deferral of 6 months from receipt of funds until you make payment. There's no prepayment penalties associated with the loan. So as Ryan noted at the beginning, they were giving the May 7th no harm, no foul date. But also, if you have some monies left over that you tried to spend, but maybe you couldn't for some reason, you can prepay. You don't have to take a loan. It does bear 1% interest, which will accrue over the 6-month period of deferment and throughout the loan. So I wanted to talk about economic need because this is the hot topic, especially with Shake Shack and Harvard the last couple of days, a lot of bad press. And Ryan covered this question number 31, but we're getting a lot of questions about what you can do. And there is one approach that we're recommending that you employ now to make sure you document economic need, or at least have a full grasp on your economic need. And that is cash flow forecasting. So one of the ways is to develop an updated cash flow forecast through the end of the year. It's important that you create several what-if scenarios, and this is going to support your ability to certify that your business needed the money. Now remember, as Ryan stated, there's a lot we don't know. What kind of PPE will you need in your business to make it safe? Will your employees come back? Will you need to give them a pay raise? Will there be a domino effect with your customers who maybe now they can pay, but next month their contracts aren't being renewed, so they can't pay you? So create a couple different scenarios of what can happen. Remember, the situation is fluid and we expect a ripple effect over the next year, both in business and even maybe with the virus. Once you have your different cash flow scenarios, you can understand how this PPP loan will help your cash flow, how to plan and spend the money, and where the crunch is going to be. You may even understand if your business might need more PPP to survive this crisis. This is where it's important to have open lines of communication with your lender. They can help you through this, and they certainly don't want any surprises. But remember, just because you're flush with cash on the day you get your PPP doesn't mean everything's going to go according to plan. So at this point, we're recommending maybe you pump the brakes and take a minute to do a cash forecast and see what it looks like. After all, you've already watched all the episodes of Tiger King. You've done all your home improvement projects. The weekend's coming up. Why not do a cash flow forecast? Here's some other things that you can do now. So Ryan touched on setting money aside in a separate account. It's not required, but you can certainly do that, and it might be recommended depending on your accounting system. You certainly can set up special GL accounts, or you can put special tags in your system for your eligible items. Highly recommended. Decide on your documentation and maintain your records with this documentation consistently. I've seen some lenders develop Excel workbooks, or we can help you put one together that's suitable for your business. Review your FTE calculations and model out your cash flow monthly, quarterly, and yearly. Calculate those FTEs at your critical points to see what it's looking like, and keep your bank in the know. And finally, have a plan A, have a plan B, and in this day and age, let's go with a plan C as well. So at this point, I'm going to turn it over to Stephanie, who's going to handle the next polling question.
Okay, thank you, Bethany. So this polling question, have you started to rehire your furloughed or laid off employees? Yes, not yet, or we didn't experience layoffs or furloughs. So as a reminder, to be eligible for CPE, the 3 polling questions must be answered. And we'll give you a moment here to go ahead and respond to the question. So we're going to get into some of those burning questions that you may be having right now. And we're going to start by talking about, do I pay my employees to stay home? So you received your PPP funds, but your business isn't open. What do you do? Well, I know that it sounds scary, and it also could be a sweet deal. It depends on what side of the deal that you're on. So this, in fact, is within the spirit of the Act and the PPP. So while you would be paying employees to stay home, at least for a period of time, the intent is to keep people employed, reduce the strain on the unemployment system, and have people in place when businesses are ready and permitted to reopen. So in the interim, consider finding ways to give employees work, whether it's on different jobs, developing or typing updated policies and procedures, participating in virtual learning or training, cleaning or painting your business in preparation to fully open, or adopting shifts or rolling schedules. The point I'm trying to make here is that you may just want to get creative in how you engage your workforce. So what if your business is dependent on other industries that are not fully functioning yet, and I only have enough work available to bring back part of my workforce? Unfortunately, that is a likely reality for many businesses right now. There is the potential for a mathematical reduction of the amount that is forgiven, as Bethany talked about, both due to the diminished payroll spend during the 8 weeks, as well as the FTE retention haircut that is part of the Act. While there is the June 30th restoration component, which, if successful, could remove the impact of the FTE's haircut, however, you may still have that diminished payroll spend. So can I utilize PPP funds to pay for bonuses or pay increases? So right now, nothing in the current guidance today prohibits you from increasing pay or offering one-time discretionary bonuses to your employees. We recommend that any pay increases or discretionary bonuses given during the cover period be thoroughly documented. Make sure that you take time to think it through. Outline your methodology and note the time period that the pay increase or the bonus relates to. Is it a permanent pay increase, only temporary during the 8-week period? Make sure you're clearly communicating to your employees as well. So for example, you can give your employees a $2 per hour pay increase during the 8-week time period, or pay a one-time $1,000 discretionary return to work bonus, or maybe even a thank you bonus. Either way, ensure that it's a fact pattern that you feel comfortable supporting and that it's fair, reasonable, and equitable. Be sure to clearly document the business case around your decision-making process and consider establishing a coronavirus pay increase or bonus code so you can pull reports from your payroll system. Can we retroactively pay our employees when you bring them back to maximize the FTEs? And the simple answer to this one is no. So doing so would jeopardize the employee's unemployment compensation that they had been receiving. And it can be potentially viewed as fraud since the employee was collecting unemployment at that time, and they didn't have reporting capabilities to report those earnings. So instead of retro pay, perhaps consider some other type of discretionary bonus or base pay increase that I just spoke about on that previous slide. Here. Okay, so question is then, who notifies the Department of Labor and Industry when an employee returns to work and goes off of unemployment? So the onus is going to be on the employee. They're the ones that need to properly record their earned wages. And if there's an overlap between returning to work and receiving unemployment compensation, the department will adjust their earnings or their compensation awarded accordingly. And then once the employee is fully back to work, they will no longer file their biweekly claim to receive that unemployment compensation. So do PPP loans cover paid sick leave? The answer to this is yes. So PPP loans cover payroll costs, which includes costs for employee vacation, parental, family, medical, and sick leave. However, the CARES Act excludes qualified sick and family leave wages for which a credit is allowed under the Families First Coronavirus Response Act. So when you go to bring your employees back after receiving your PPP loan, you might find that some of them are not going to be able to return just due to the situation regarding school or daycare closures. So therefore, then those employees would become eligible to take advantage of the leave that's offered under the Families First Coronavirus Response Act. And you would be eligible then to receive those tax credits for those programs. So in order to maximize those PPP funds, you may consider making those employees whole with their salary by paying that remaining 1/3 of unpaid compensation under the FFCRA program. All right, we've received notice that we are approved for PPP funds. What should we do if an employee resigns or refuses to return to work? Great question. If you haven't picked up on it already, the underlying theme today is thorough documentation. So we encourage you to show your good faith efforts to adhere to the requirements of the PPP loan. We recommend that you recall your employees in writing to begin that documentation process. And if an employee resigns, make sure that you obtain a resignation letter either via email or mail, noting that their last day of employment, so you can record that and maintain those records. If you've tried calling an employee and they are ghosting you and not responding to your phone calls to be recalled to work, make sure that you document any dates and times that you've attempted to contact the employee. Certainly try more than one time. And keep notes. So if you've left a voicemail either on their answering machine or you spoke to somebody that answered the phone, make sure that you're taking copious notes so you have that information. And then lastly, send a recall notice letter to the employee's residence along with a return receipt notice for documentation. With your recall notice, you should include the expected date of their return along with the time period in order for them to respond to your notice to recall them back to work. So I know this is kind of small and hard to read. I'm going to talk about it a little bit. So this is an example of a layoff or furlough recall letter. So in this example, the letter provided is provides a return to work status and a date along with the expectations upon arrival as it would relate to any of the government or CDC safety guidelines that employers must follow in order to bring their employees back. So you want to make sure that they understand and are informed of what they can expect upon return and any rules or guidelines that they must follow once they're there. It also notes that their failure to return will result in a voluntary resignation and may impact their eligibility for unemployment. The second page of this example is for the employee to actually complete and return to you. And in here, they would check off if they are going to report to work on the date that you have requested, or if they will not be returning, and this is them resigning their employment effective immediately. So therefore, that would be providing you with the documentation that you would need for your PPP forgiveness and the Department of Labor and Industry. So once you've provided that recall notice in writing and the employee informs you that they won't be returning to work, you have 7 days to notify the Department of Labor. So the Pennsylvania Department of Labor provides the UC 1921 refusal to work form that you will fill out and return along with any of that documentation. So it's the documents that you collected either through the recall notice or the notes that you've been taking as you were trying to contact them, and copies of the letter that you have mailed to their home, or even just if they have their resignation letter that they've provided you, you would submit any documentation that you have to support that they need to be notified of the failure to return to work. So the best way to submit this form is by going online onto the PA Department of Labor's website, fill out this form electronically, and at the bottom they do have a submit button, and then it's done. If you needed to print it out and fax it over, you can certainly do that, but I highly encourage you to do the electronic version. It's a lot faster, and remember, you still only have that 7-day window to get that information to them. So lastly, I'm going to touch on what happens if your pay cycle doesn't fall precisely in between the 8-week covered period. The guidance that we have today from the SBA is costs incurred and payments made within the 8-week period will be forgiven. So let's say, for example, that your covered 8-week period starts in the middle of your pay cycle, where 1 week is prior to the effective date of your PPP fund your PPP funds hitting your bank account, and then the second week falls within the 8-week period. So per the existing guidance that we have today, you can only count the 1 week towards your PPP loan forgiveness. And conversely, if your 8-week loan period ends on June 13th and your payroll pay date is on June 15th, again, per the guidance that we have available to us today, you can only use payments made during your 8-week period. Therefore, since the payment was made outside of the loan period, it cannot be counted for loan forgiveness. Until further guidance is released, we encourage borrowers to follow the guidance that's available at this time and only use PPP funds for costs incurred and paid during that 8-week period. You can always consult with your bank to see if there's any other way that you can capture those payments, such as running a special payroll that would allow you to capture those payroll expenses in order to maximize the usage of your PPP funds. Maintaining regular and transparent communication with your bank is definitely going to be in your best interest. So that's all I have for now. I'm going to turn it back over to Ryan to close out our session here.
Okay, thank you, Stephanie. With that, let's bring up our final polling question. This is our fourth question. It is more of an optional polling question as we're trying to gain some insight on ways that we can be helpful to you beyond what's on our website and outside of our webinar series. So the polling question should be up. Please indicate if you have interest in any of the following from RKL, and feel free for this one to check all that apply as opposed to those other ones where it was just pick one. This one you can pick 0, 1, all of them, however you want to do it. And remember that this one is our fourth and kind of our extra polling question. The choices are PPP loan forgiveness computations and cash flow forecasting, net operating loss tax planning, remote cybersecurity assessment, human resources payroll matters, investment review and benchmarking. Other questions which we can reach out to you specifically on those, or if no follow-up is needed, feel free to check that box as well. And with that, we'd certainly like to thank you for joining us again this week. You can see our email addresses for each of our presenters, so you can feel free to reach out to us specifically if there's anything you'd like us to clarify. Also check out our Coronavirus Resource Center on our website. You'll be able to have a copy of this presentation that you can download with the audio. That'll probably be released sometime later this afternoon. So if there's something you weren't sure if you heard correctly or need to go back, you can feel free to do so and gain access to a copy there. We also have a lot of written publication, blogs, and so forth that have additional insight with what we know at this point regarding the coronavirus, guidance, tax implications, other stimulus packages, all sorts of things. So thank you again for joining us this week, and be on the lookout for an invitation for next week at 11 a.m. on Friday. Thank you for coming, everybody.